Howdy there, folks. Welcome into this video. 5 little clips for me to react to in this one. Yes, it's a 5-piece. First one up here is actually one I recorded for you guys from Fast Money. This is a good little bull and bear debate between Dan Nathan and Gary Black in regards to Tesla, what's actually going on with the company, what they kind of see moving forward and things like that. So that one's an intriguing one. Then I'm going to go ahead and react to this one. It's a 3-minute clip. Ross Gerber talking about Tesla and also speaking about Tesla advertising, right? So that should be an intriguing one, and I'm looking forward to kind of getting into that one. I don't know if I've ever really talked about my stance on Tesla advertising before, so that one should be intriguing. Then we're going to get into this one. The market is already oversold, says Piper Sandler. So I want to hear what he has to say in regards to that and kind of share my opinions and perspectives. This one, the earnings recession is pretty much over. Oh, okay. So that sounds like an interesting video to react to. And last one up here, the options market implied move for Meta is on the cheaper side. So I want to hear what they have to say about this one. Obviously, Meta and Amazon are reporting this week. Also, Google, McDougal, Microsoft, Visa. You got a lot of big dog companies reporting this week. Appreciate everybody joining me as always. This is a little beast of a reaction here. 5 different ones to get through in this one. Pin comment down there if you want to join my Patreon, see what moves I'm making in the market, what stocks I'm buying and selling, which just yesterday I bought 4 stocks in there and sold 1 stock. So if you want access to see that, pin comment down there. Alrighty, guys, let's get into this.
Takedown. We were battling over the future of Tesla and the EV explosion. Our bear, the one and only fit and fighting trim Dan Nathan, well, future fund managing partner Gary Black, who joins us on the fast line tonight. We had some technical issues with his picture. Gary, you'll get the first swing here. You still like the stock here? You know, a lot of people were commenting on the conference call that Elon sounded really down and out. He blamed everything under the sun, higher interest rates.
By the way, if you don't know Dan Nathan, he's always insanely bearish on Tesla. Every time I've ever heard him talk about Tesla over the years, always comes across as super bearish, always comes across like he has a personal vendetta against Elon Musk as well. So just do keep that in mind in regards to this video here today.
Macro environment, geopolitical, but this is still your second largest position.
Yeah, look, the conference call was lousy. The earnings were lousy because they missed on the most important metric, which is auto gross margin. And the quality of the earnings were light because it was all based on reg credits and lower tax rate. But when you think about the stock, it's trading now at 52 times. It's growing its volumes and earnings at 35% between now and 2027. I'm a growth manager. I can't find stocks that trade at 52 times that are growing at 30 to 35%. So we still like it.
In terms of volumes, you had noted on Twitter, Gary, that past price cuts didn't yield an increase in volume, and there's concern now that Tesla will continue cutting price in order to compensate for higher rates, which would hit the consumer in the form of the auto loan, auto financing. So, you know, to what end do they cut price at this point if you say that the incremental volume is just not materializing?
Yeah, there's been no demand elasticity, despite what Elon says. You know, if you look at where the estimates for 2023 were at the beginning of the year, and then you look at where they are today, they're exactly the same. If you go out to 2024, they're actually lower. So you're not getting any volume growth for these price cuts. So we've been advocating stop cutting price, put some money into advertising, use that as another tool in your marketing toolkit to try to get more volume. Because I don't think by cutting the price of the Model Y from 50,000 to 48,000 is going to get you any more incremental volume. And I'll go so far as to say that if you look at monthly payments of them.
So let me push back against that for a moment here. I do believe what Elon's doing is genius. My personal opinion, I have maybe a little bit of a different view. And obviously, if you're talking about for short-term numbers, it's absolutely the wrong decision to make, right? It destroys profitability, it destroys margins. But I do actually believe he has made the right decision. And the reason I believe he's made the right decision is now, for the first time in Tesla's history, Tesla's seen as the affordable vehicle for the middle class between Model 3 and Model Y. It's never been like that. But because of all the price cuts they've done, and then if you add on the tax credits on top of that, now Tesla is seen as the affordable vehicle to the masses. That's a huge game changer. Now, it takes a while to like get that into everybody's brain and everybody realize, oh, Tesla's making affordable vehicles. There's kind of a lag time there. You know, we talk about the Fed lags, right? There's a lag time before it gets to consumers and everybody starts to recognize, oh my gosh, Tesla's the affordable vehicle for the masses when you break it down on the math, just math. And never mind the quality of product you get for the price points they're at now at this point in time. And so that's a game changer, right? The price of a Tesla has come down dramatically. The price of ICE vehicles have been going up dramatically. And so we're at this kind of match made in heaven time for Tesla now, where, in my opinion, over this next year, by this time next year, I think it's going to be through to most Americans that Tesla's the affordable vehicle and the right financial decision to go get. I think it just is one of those things that takes time. And so that's why I think you haven't really seen the volumes kick up quite yet. I think you will. It's just there's a lag there, okay, between doing all those price cuts and then getting out to the masses and everybody realizing, oh my gosh, these are so affordable.
Why today, if you took out a 5-year auto loan and rates have gone from 4% to, let's say, 7.5%, but the price of the Model Y has come down by 20%, the payments are actually lower today than they were a year and a half to 2 years ago. So
true. Now, one last thing in regards to this whole price reduction, everything that's happened there. Do I believe Tesla should lower prices anymore? My opinion is Tesla should not lower prices anymore. I think at this point in time, they've done what they've done. It's clearly the 3 and the Y are now two of the most affordable vehicles to the middle class. And I think we can just stay where we're at or potentially even raise price a little bit in 2024. But I think we're in a great position. I do not believe we should lower price at all anymore. I think we need to be done with any sorts of price cuts.
I don't understand the logic of why they have to keep cutting the price. And look, I think at the end of the day, they're going to see that they're not getting any demand elasticity, despite what they said on the conference call last night. So we think that there might be another couple of price cuts, and we may see margins come down a little bit more. But I go back to, I got a stock trading at 52 times next year's earnings, growing at 35% a year, and I can't find stocks that trade at a PEG of 1.5 in the growth universe.
So to push back against Gary Black here, I love pushing back against my fellow Tesla bulls. We don't know that Tesla's really trading at a 52 times 2024 numbers because we don't really know what margins are looking like in 2024. We don't really have a clue right now because we are in the dark on if Tesla's going to do more price cuts, what the demand environment is going to look like. So I just want to push back against that because there's no real clarity there right now. Tesla's not as messy as like a Solar Edge situation or like the solar stocks right now, but to be quite honest, we don't really know. We don't really have a clue what Tesla's going to earn next year because we don't know the margins. We're completely in the dark in regards to when the margins bottom and what number that is.
Right, but Gary, that revenue growth is decelerating, right? The delivery growth is decelerating. And I remember listening to you, I think it was on the last call in April after the Q1 earnings report. And I remember, I think you said that you sold a part of your position. You were not happy with the price cuts. That was all the way back in April. And if I look at this stock and I look at now the 3 reactions the day after it's reported, it's Q1, it's Q2, and it's Q3, it sold off basically 10% each time. So the big money out there is selling on those days. You seem to be very frustrated with his strategy. You seem to not buy the math that he's giving, and the CFO, who does all the math, right? Like he left a couple months ago without really a statement or anything like that. So maybe there's some funny math going. And I listened to the same call that you listened to, and I give you a lot of credit. I was reading your Twitter this morning. You were being very honest.
Maybe there's some funny math going. Like I said, if you guys got to see what I've seen over the years from Dan Nathan, you would know this man despises Elon Musk and really hates Tesla. Like the things he said over the years, holy smokes, man.
Are you selling, if you were selling stock after the Q1 call when the stock was $175, are you selling stock here at $220? Because it looks like the fundamentals of this company, at least as it relates to the autos, are deteriorating. And if simple math about price elasticity is not working for this company right now, why are you sticking around waiting for that growth to decelerate further if that's the case? And we haven't even had the recession yet, okay? So that's the other point I would make.
Yeah, well, we got a couple catalysts ahead. So one, the Cybertruck is going to be huge. If you go out and you talk to pickup truck owners, and you got to talk to all of them. You can't just talk to 65-year-olds that drive F-150s. You talk to 30-year-olds, 40-year-olds. We go out and we do that. What you find is people love the look of the Cybertruck. The Cybertruck will be out in about 2 weeks. It's going to be a rolling billboard, and you're going to see it, and you're going to get excited about it. And you may not buy a pickup truck, but you're going to go to the Tesla website. You say, wow, that's really neat. What is it? I can't even imagine the social media buzz that you're going to get when that Cybertruck starts rolling all across America.
True.
And there's a halo
It's true.
effect that will come with that. That'll ignite the entire franchise. That's one.
That's
Two,
true.
they didn't talk about this. I'm not sure why, but there will be at some point an FSD licensing deal with another OEM. It's probably going to be like a Toyota or a Honda, and that's going to get people very excited because there's going to be other FSD licensing deals. And then the third thing is that the energy business, which has always been very small, is now the highest margin business. It's 24% margins. The auto business is 16%. That thing tripled in the third quarter versus the third quarter a year ago, and people aren't putting any value whatsoever on that. So I think there's a bunch of catalysts ahead. And then the $7,500 IRA credit is going to go to off invoice January 1st. So I got a lot of catalysts, and you're right. The volumes have been decelerating. We're probably, if they hit 1.8 million for the year, that means that their volume growth for the fourth quarter is only going to be 18%. But I think they can get back to 30%.
Unfortunately, we got to leave it there. We'll have you back, hopefully. Gary Black, a future.
So I would have definitely loved that. To have been longer. I would have loved to have them go back and forth for another easily 5-10 minutes. I could have listened to them go back and forth because by the time probably another extra 10 minutes, they probably would have just been circling the wagons again and again and again. But bottom line is, margins likely bottom next few quarters. Big question, is it 2 quarters they bottom or is it 4 quarters? I think that's the big question, right? I think we're probably closer to the bottoming in the next 2 quarters. That's my personal opinion. I think we got another really tough quarter with margins coming, obviously, which will be announced. When will that quarter be announced? End of January, beginning of February. And I think the quarter that would be announced in April, it'd be April. It should be April. That's going to be another quarter that I think it's going to be really, really tough on margins. After that, I think it's open season for potentially our margins actually starting to increase. That's just my personal opinion in regards to that. Alrighty, next one up here, Ross Gerber. Let's hear what he has to say and share my opinions.
Stop with Tesla. Officials at NASA apparently getting impatient with SpaceX due to the rocket company's moon mission delays. Let's talk about everything Musk and Teslarian. Joining us tonight is Gerber Kawasaki President and CEO Ross Gerber and Wall Street Journal tech reporter and CNBC contributor Tim Higgins, also the author of Power Play, Tesla, Elon Musk, and the Bet of the Century. Ross, obviously, listen, Tesla's made people a lot of money over the years. 1 week, a couple months does not a trend make. But I follow you on Twitter, Twitter, whatever you want to call it. You'd like to see some changes at Tesla regarding advertising and some other things, correct?
Yeah, I mean, as you go back a year, this is what caused me to run for the board. And we kind of came to terms, and Elon again reiterated that he would look into advertising, and they have done some things, but it's just such a minimal effort. And just now on X, we're going back and forth with Elon and Omar about the Sphere and what an amazing advertising vehicle this is in Vegas. And I was like, why isn't Tesla putting ads on the Sphere? So it's not like he doesn't hear me or see it, and I just don't understand the reluctance when every company in the world advertises, and there's a reason we do, because it actually works.
Well, you didn't need to advertise, Tim. If you had it, listen, I know people bought Teslas. I drove the first Tesla, I think 2009. I know people, they bought them. They're never going to drive anything ever again. They were like, almost a cult in a way, right? They would go up to somebody and say, dude, you got to drive my Tesla, right? With these big eyes and whatever. Now there's competition, Tim. Now there's actual competition, to Ross's point. Maybe you need to convince the non-believers why your car is better than the other guys.
No, that's the argument. Yeah, it used to be viral marketing, and now what do you got? Well, Elon would say that the bigger issue is that they're getting people to afford the car, and that's why he's spending so much effort to kind of whittle away at the costs behind it. It's more of an issue of people being able to get into the vehicle, not that they know about it. He essentially argued that everybody knows about this car and want it, but they just can't afford it.
Yeah. Do you think, Tim, that the price cuts are going to help? Because they're damaging margins, so they better work in getting more people's butts in a Model 3 and a Model Y. Yeah,
the risk with advertising, right? Because it sounds good in theory. Just advertise. Let's just start putting ads. Let's put ads on the Sphere. The Sphere. Here in Vegas, my city. Yeah, let's put ads on that. Let's start running YouTube ads all over the place and running ads all over my Twitch channel. Let's do that as well, right? And start putting ads on Facebook and on the football games and stuff like that, right? sounds cool in theory. There's two issues with ads, okay? First one is, I believe that Elon views ads as uncool. And so I believe that if Elon thinks we're going to run ads, it's going to make Tesla uncool. Now, I don't really have a strong belief in regards to that or not, because most companies do it. So do keep that in mind. There's very few super successful companies that don't run ads. I mean, maybe I can think of like In-N-Out Burger as being one of the very few like really successful companies that don't run ads, but almost everybody runs ads. So it is what it is. But the other risk you really run, that's a pretty serious risk if you run ads, margins, right? Margins. If you're going to spend a bunch of money on advertising, let's say even $100 million a quarter, so there's a $100 million hit at the end of the day to your bottom line. And so it is a hit to profitability. Now, hopefully that increases volumes to compensate for that, but that's a big game of kind of cat and mouse and trying to figure out how much you need to spend to get that money back, right? Because Tesla's going to need to spend probably quite a bit to get another customer, and have them believe. So, it sounds so great. Oh, let's just start running ads, but it's not as easy as that, man. It's a complicated world. It's a complicated business when you start to add that in. It's a fundamental change in the business model.
Well, they've worked somewhat, but you think, given how much they've cut, you perhaps think that the volume increases would have been maybe bigger. At least that's what some people talk to me say. There is this argument that maybe it would be cheaper and better for the brand to be spending that money on advertising, at least to be kind of teaching or educating a new audience about the brand.
Ross, listen, Elon Musk, whatever you think of him, is going to be one of the greatest businessmen in the history of the world ever. But do you feel like he's stretched too thin?
Well, if you consider him a human being, I don't know how he's not. And, if you look at reading his book, he basically works 3 years for every 1 year that the rest of us work. And he doesn't take any time off or vacations. And it takes a toll on people. Elon and I are now in our early 50s. And honestly, I'm exhausted just running one company with 2 kids. So, I'm in a lot better shape than Elon, to be honest. So I think it's a point where you got to look at yourself and say, I want to get to Mars and I want to build this company that's going to sell 20 million EVs. But, is the toll X is taking on me, is it really worth it if it prevents me from getting to my real goals?
You think you should try to sell Twitter/X?
Well, I think Bill Ackman wants to help him buy it. So, quite frankly, I'm an investor in X, to be honest. I'd love to be able to get my money out.
Yeah.
Interesting. Yeah. In terms of my thoughts around what is Elon's plan with X, I think this is just my belief, okay? I have no inside knowledge of this. This is just my belief. I believe what Elon Musk is up to with X is I believe he's getting them on stable footing. I believe he's going to start building back the revenue base quite substantially in 2024, regardless if there's a recession or not. And I believe he's going to be able to show a huge increase in how much their revenue is going up in 2024 versus 2023. I also believe he's going to be able to show some great user metrics as well in 2024. And so I believe it's going to position the company where they could actually take it public in 2025. And that's what I think is going to happen. I think he's going to take the company public. He's going to sell a bunch of his shares. He'll keep some and then figure out what to do with that money at that point in time. So that's my guess. That is my guess in regards to what he's up to with X. Stabilize it, build it, because there will be a lot of people actually genuinely excited to buy X stock when it comes public if he's showing like user metrics are picking up quite substantially and if he shows revenues are going up a lot in 2024 versus what they were in 2023, right? As they get their advertising business. Because then people are thinking, okay, it was going to grow into 25, 26 and beyond, right? So that's my belief on what he's up to with X. We'll see how it all plays out. Next one up here. This market is already oversold, says Piper Sandler Craig Johnson. Want to hear what he has to say and react to this one.
Joining us, Managing Director and Chief Market Technician at Piper Sandler, Craig Johnson, and Founding Partner and Chief Investment Officer at G Squared Private Wealth Management, Victoria Green. Craig, you're holding steady. You got a 48.25 target on the S&P 500, which is a lot of upside from here. Make the bull case.
Brian, it's about 14% upside. But, this lead in you had here, talking about all these negative things, interest rates, oil prices, geopolitical uncertainty, all these things. If you would have told me all these things put together, Brian, and we're only 8% off of a 52-week high, I would have said no way. This market is pretty Teflon in here at this point in time. And when I look at the S&P 500, all we've done is sort of correct back to and sort of just slightly undercut today. Key support levels at the uptrend support line.
It's not that crazy. Stuff in the Middle East is always going on, okay? Middle East always drama. Nothing new. Oil prices in the 80s right now. I mean, we're acting like oil prices like $120, $150 a barrel. It's in the 80s right now. So all this stuff going on and, man, it's crazy. And I think the market would be down. I don't know about all that.
The 200-day moving average. So, Brian, from my perspective, the market's already gotten oversold. We're already seeing divergences in terms of interest rates. We're already seeing this market fairly oversold on some overbought, oversold oscillators. The breadth of the market has already deteriorated. We've thrown a lot at this market, and a good friend of mine always says, one doesn't get hurt falling out of basement windows, and it sort of feels that's where we are compared to all these
Craig, you said that we started the show all negative, and then you just listed all this negative stuff, but I guess it sounds like you're saying that's it's good now that the bad stuff is getting out of the way.
Yeah, you're getting a lot of the bad stuff out of the way. The market is already sold off to a degree in here. But I think once we get some clarity brought in.
Man's office looks depressing. I'm just going to be honest with you. So I don't know, man. He's got to look at something positive.
What's going to happen in Washington, get through the earnings season, these kind of things. I think there's a real meaningful pop. Again, we're sticking with our 48-25 year-end objective, Brian, and we think that there's still decent upside to go here.
Victoria Green, I know you're not a technician. You're a fundamentalist. You look at, Craig's looking at one thing. You may be looking at another.
So he's insanely bullish, obviously. I mean, expecting 14% S&P rally into year end, 14 flipping flapjack in percent. Okay, let me tell you what needs to happen to get us 14%. One, Middle East can't get any worse. It just is what it is. Two, we need, for the House to figure out that situation, okay? And obviously Washington. Third, we need Meta, Amazon to come in and absolutely kill it. We need companies like Apple and Microsoft to put up good numbers and, not the end of the world by any stretch of the imagination. You need Google to come in, smash it. You need Visa to come in, smash it. You need companies that are seen as like the weaker, bigger tech plays, right? Smaller plays in the big tech fields like the PayPals to come in and smash it. And if you have all that happen, maybe we can get that 14% rise, but we don't have much time left, folks. There's less than 50 trading days, if I recall, in this year. Less than 50 trading days. So to get that sort of move in the SP 500, you need a lot of things to go right. And I mean a lot of things to go right. Oh, and you know what else we're going to need? We're also going to need the Fed not to raise anymore this year. We're also going to need CPI to start coming back down over the future months. I mean, damn, man, we need a lot of freaking stuff, okay, to get a 14% rise. If we were just talking about 5%, it's like, oh, we could get a few things. 14%? We need so many things to go right. It's almost a miracle.
I understand that you completely disagree.
Yeah, just a little bit. And no offense, Craig, but I'm like, let's talk about this at the end of next week after we have, you've got Meta, Google, Amazon coming in with their earnings next week. Tesla failed miserably. Discretionary's rolled over a little bit. We'll see if Amazon can hold up. Impossible for this market to rally if you do not have earnings confirmed next week. And you've got 17% of the S&P 500 reporting. That's barely holding those supports there. And so if we do break 4,200, it does kind of invalidate his bull thesis. And you have all these macro headwinds, and you're just not seeing some of these stock fundamentals hold up. Everybody wants to talk about earning revisions are better, but we're not seeing it. And you have these little pockets of the market that are working. Those are the ones that drove us up. If you start looking at sectors, it was discretionary, telecom and communications, or not telecom, I'm sorry, technology and communications that drove us up. And now they're starting to falter a little bit, especially discretionary rolling over hard. So if those are the stocks that was the leadership, and you've got S&P equal 8, Dow and everything else, Russell 1000 value negative on the year, how can you rally if the mega caps roll over? And so next week is the one I say this is going to make or break the rally, or this downtrend we've been in since July is going to overrule this uptrend we've been in.
Yeah, one of the other things that worries me to be honest, going into year end. This worries me in regards to November and December, okay? And I don't think this is being talked about enough. I'm sure you guys have seen what's happened with dividend stocks this year. If you watch me on the main channel, I've covered it about 1,000 times over the last few weeks. Dividend stocks have been obliterated this year. They've had arguably the worst year for dividend stocks probably since the Great Financial Crisis. It's been horrible. So we could see continued tax loss harvesting into November, December, which would continue to put, let's just call it pressure on a lot of the Dow type stocks, a lot of the dividend type stocks. Just some food for thought in regards to that. So yeah, that's just another factor that makes this call that he's trying to make here tough in regards to 14% S&P 500 over this next bit of time here.
October last year.
So Craig, Victoria said, how can you rally if the mega caps roll over? So I'm going to ask you this. How can we rally if the mega caps roll over?
Brian, let me say this. I respect the fundamental perspective in here. But again, I don't see people driving cars looking in the rearview mirror. Okay, so when we come back and we start looking at where the earnings estimates are at, Victoria, let's start rolling out to the 2024 numbers over 23. You're still talking about 12% year-over-year growth. You're talking at a multiple that's one turn higher post-World War II. A lot of this stuff is already priced in. And you go back and you look at the amount of cash sitting on the balance sheets of Apple, Microsoft, and all those companies.
A bear might look at that and say, oh, you're talking about 12%, earnings growth in 24. Well, you might not get that. Well, the same thing you could say, well, the bears are always talking about, oh, we're going to have a recession. Well, we might not have that, right? So both sides can play that of the whole game of that might not happen, right?
Again, tons of cash there, higher interest rates. They're probably going to be better than what a lot of people expect. And the earnings revision numbers, they're not coming down. So at this point in time, you're at a point where you've already baked in a lot of this negative nervousness, and you're going to see this market work to the upside. And I'd be a buyer here, not a seller. I'll take the other side of the trade, Victoria.
Absolutely. I'll buy you a beer next week if it holds. But, I'm a little worried that it's going to roll over a little bit like my poor little Astros. They just chased Verlander. Rangers have made me a little bit sad. So I'm a little worried, but we'll see who holds out here. I'm still calling with it being a little bearish. I think there's too many macro. And instead of if you're looking forward, let's see what Tesla said. Tesla's worried about cost for consumers. Some of the exciting new growth stocks, they're really struggling right now. You had solar rolling over, as you talked about. They're saying consumers aren't buying. Some of them returning equipment, and the cost of debt. If we have this spike and you have real rates and suddenly you have this other alternative, we're in a Tara world where investors can sit and make money.
Okay, so, Tesla, solar, all that stuff, okay? Remember what I told you guys, a year and a half ago. Watch out for anything that people have to take out loans for. The Fed's raising rates. It's going to make the cost of capital obviously go up immensely. It's going to cause problems, right? And sure enough, we've seen over this past year a massive pullback in the amount of people buying homes, amount of people buying cars, amount of people buying furniture, all those things, right? And so it's just a process you got to work through. But that does not, just because people aren't buying the thing that is $100,000 that they got to take out a loan for, or $500,000 or $50,000, doesn't mean people aren't buying the thing that's $10. Okay, so that's where you get in the differences between a Meta and Amazon and some of these other companies versus, let's call it something like a Tesla that's selling, $40,000, $50,000, $60,000 vehicles.
Cash, your equity risk premium's the lowest it's been. There's options out there beyond buying stocks, and I know the cash thing. A lot of people say that's bullish, but I see it as an option.
Okay, I love the bet because Craig's in Minneapolis where they probably already have 3.5 feet of snow on the ground. I'm sure he doesn't drink at all. But it's Feel Good Friday, which I just invented like 5 minutes ago. Can you give us one idea? You're a little worried, but there's got to be something you like quickly.
Oh, absolutely. I love Netflix. They did great last week, and they're being absolutely brilliant how they're rolling out ads and adjusting pricing. So they're trying to drive people to that ad-based tier at $6.99, so then they can get ad revenue, plus they're getting their membership subscription revenue, and that's going to drive their average revenue per user up. So I see them as having just a really good strategy. And Brian, I'm bullish oil. It's a good time to be sitting in some of those. I think Exxon might crush it next week.
Interesting. Yeah. No opinion on oil and gas stocks, but Netflix. I mean, it's Netflix. That's always a pretty safe company if you've got a longer term horizon. If you're trying to play Netflix for a 6-12 month span, dangerous. But if you're trying to play Netflix for a 5-10 year span. It's just always been that company is so well positioned this past decade. They're going to be well positioned for the next decade. They just are that company, right? Next one up here, the earnings recession is pretty much over. Let's hear what they're talking about here and react to this one.
The market and the impact of rising bond yields. While market history shows stocks tend to rally into the end of the year, the sell-off in bonds and rise in yields has put a damper on what has been a strong year for equity markets.
You're telling
generally.
me?
So what does it all mean, and where do we go from here? Let's bring in Dryden Pence, Chief Investment Officer with Pence Capital Management. Also with us, CNBC contributor Sarat Sethi, Managing Partner with DCLA. He is our guest host for the hour. Welcome to both of you. Good to have you here. Dryden, let me begin with you with your thoughts on bonds generally. There's been some talk. I mean, lately you've been paid to keep your maturities very short, whether you're in the Treasury market or elsewhere. Are we getting to the point where it might be time to go out a little farther on the duration curve?
Well, I think that people are beginning to realize that the interest rate regime is now going to be higher for longer. And therefore, those people who've been very, very short can begin to move out just a little bit because yield curves normalize. We're in this situation where we're now gone from very inverted to closely flat. And I think that the realization is that this movement from higher to longer is going to allow people to move out a little bit on the yield curve because, quite frankly, the idea that we're going to have a massive move down in 2024 is probably certainly off the table.
Sarat, what do you think there? Are we getting close to the moment where you would think about going out and lengthening your maturities if you hold bonds?
So I would be careful with how far out you want to go. I think 3 to 5 years can work, but you have to be very careful about credit quality if you're talking about corporate bonds. And I think we haven't really seen spreads blow out, meaning we haven't really seen stocks, balance sheets reflect some of the refinancing coming, some of the higher rates, and a potential slowdown in the economy because that's what the end result is going to be of all this tightening. So when you do go out 3 to 5 years, make sure that the credit that you're holding is of high quality and not cyclicals and not companies that are going to have to go back to the market very shortly or that are depending on advertising. So just like when you do stock picking, you got to be careful on the bond picking side too and know that your spread, the difference between the treasury and what you're getting paid for is commensurate to the risk you're taking.
Some people might say or might argue or might think, well, I can't do that work. That's how I would feel as an investor. How would I possibly know? So would I be safe enough buying, some kind of broad exposure and hoping that even if I lose 10 or 20% at the margin because of defaults, I still might come out ahead?
And I think that's when you get a short-term diversified bond fund for that amount. But you have to be careful because it does have volatility. So it's, we prefer owning the individuals, but totally. To your point there, or if you don't think the risk is enough, just buy a short-term treasury fund or something to that effect where you're not taking credit quality.
Do you think people should go into their Fidelity accounts, just look for Apple bond CUSIPs and just load up on that? I mean,
well, so the spread over treasuries, is not that commensurate to take the risk.
True.
Apple's not going to go out of business, so that's kind of where you're going to have to play that amount. But an A-rated, highly B-rated companies that are 50, 60 over 60 basis points over the treasury, those you can be comfortable with. So you can do it with high-quality companies. Just don't go into companies that think, I'm getting 9% for 2 years. Well, the bond market is normally more right than the equity market, so it's telling you something that probably much more risk there than there is.
A lot of people have been asking me about TLT. When do I think it's the right time to maybe potentially play TLT, which TLT's gotten destroyed, absolutely wrecked. Pretty much the worst it's ever been wrecked, and specifically over this past, I would say, year and a half or so, if not 2 years. So my opinion is TLT will probably be an interesting play around Q1, Q2 of 2024. That is kind of my thought process. I'm not at all convinced necessarily TLT's done going down as of right now. And I think especially if the economy stays in a pretty good place here for the next bit of time, I think it's going to add even more fears. And I think TLT could even push down even further. And when I say more fears of like treasuries going higher and potentially a situation where the Fed has to raise more or anything like that, I think there could be worries about that. So yeah, I think TLT will be interesting as a potential get in Q1 or Q2 of 2024. But with that being said, you also have to ask yourself, are there better places to put your money, right? than something like a TLT. So that's something that has to be considered by everybody out there before they put money in something like that. It's like, is that really the best place to put your money in Q1, Q2 of next year?
What do you think of stocks and the so-called earnings recession that we may have just exited?
Well, I think the earnings recession is over, and we looked at, you had the Magnificent Seven the first part of the year, and now we're looking more towards the 493 because the earnings recession is pretty much over. You're going to see continued growth in earnings throughout the market that we believe through the end of the year and then into next year. So I think the economy is fairly strong. It's going to continue to be that way, and I think that's going to be supportive for the rest of the market, that 493, to begin to have increase in earnings. And we think the recession's over. I mean, the Magnificent Seven ended their earnings recession 3 or 4 quarters ago. Now the rest of the market is doing that, and we can move forward to, we think, a pretty broadening, more positive, more strengthening.
So I 100% agree with that gentleman in terms of earnings recession being over. I mean, if I just track all the companies I own specifically, which I own a lot of freaking companies, okay? Almost all of those companies are going to report significant earnings per share growth in this quarter they're about to report versus last year at this time. I think pretty much almost every single company other than maybe Tesla. Tesla's the only one that comes to mind that, I was like, oh, they're probably going to report down numbers year over year. Almost pretty much every other stock, which I probably own another 20 plus stocks, if not 25 stocks, I don't know of one that I'm like, oh, their net income EPS is going to be down. Maybe Foot Locker because they're in a restructuring period right now. But man, in terms of this upcoming quarter, all these companies that are about to report, almost every single one. I mean, Meta and Amazon, perfect examples. Meta's earnings per share is going to be up so ridiculous, it's going to blow your mind. Amazon's earnings per share on a year-over-year basis is going to be up so much, it's going to blow your mind. So, yeah.
To the exchange, several big tech names report earnings next week, including Alphabet, Microsoft, Meta, and Amazon. And with the Magnificent Seven under pressure as rates continue their climb, let's check in with what the options market is signaling. For today's edition of Tech Check, Chris Murphy is here. He's Susquehanna's co-head of derivative strategy, along with our very own Deirdre Bosa. I'm going to build the suspense to Chris for just a moment. Deirdre, give us a sense of where you think investors or Silicon Valley are most focused.
So for each company, it's going to be different. But as a whole, and we always talk about this when earnings season comes up, these are such big parts of the broader market that a miss from any one of these 4 names next week could take, markets down with it. So it's really critical. However, expectations are pretty good. These companies are more like flywheels. They're platforms with many different businesses, and they're almost seen as defensive stocks in this kind of environment. They've had a tougher second half of the year, but year to date, they're still holding up the best. They've still led the markets higher this year. So different things for different companies, but maybe one thread that will be the same for all 4 of them is their AI promise versus the economics of artificial intelligence. 2 very different things. The first half of the year characterized by the hype and promise. Now it's the economics. Investors are going to look for more signs of monetization, spending. AI is very, very expensive in terms of those compute costs.
True.
And for the cloud, the hyperscalers, Microsoft and Amazon, investors want to know that growth has bottomed out, especially for Amazon, and that it's picking back up. And that's related to their AI propositions as well.
All right. So drum roll, please. Chris, what do you see in the options markets? Which are going to have the biggest moves?
Well, you kind of nailed it with the whole defensive argument. So you're seeing a little bit of a flight to quote unquote safety in these names. So the implied moves are actually on the lower end compared to what we usually expect to see because of that flight to safety kind of a nature. If one implied move looks a little bit cheap, I would look towards Meta. It's implying about a 10% move, which might seem relatively high, but if you compare how it's moved the last couple, that's on the lower end. But, the main takeaway is overwriting strategy in those.
Yeah, I could see Meta. So first off, I think Meta is going to shoot up on their earnings. I think it's going to fly higher. I think 10% is a pretty conservative number. I can see it going up a lot more than that. By the way, I have no short-term call options on Meta, so it's irrelevant. It's a huge position for me. If it goes down, great. If it goes up, great. But if I had to guess, it's probably going to be up very, very nicely on earnings.
Names selling the upside, saying even if we do come in stronger on earnings, we're not expecting much of an explosive move while there's so many other overhangs going on in the broader market right now. So that's been the general strategy that we've been seeing into these earnings events.
And anything
I also believe Amazon will blast higher as well.
Chris, that investors might want to think about, kind of outside risks or just...
I also think there's a chance, and NVIDIA is not reporting for a while, but I do believe there's a potential NVIDIA blast higher on their earnings. We'll see.
Broad market risks.
Well, the Treasury yield and the situation in the Middle East, that's definitely overshadowing these earnings. We're seeing correlations in general move higher. So all these stocks are starting to move together at a time when they should be moving on their own individual earnings merits. So, certainly the worst, fear for one of these names is to have a pretty decent earnings, but have the whole entire rest of the market selling off for something that's out of their control.
All right, Deirdre, quick last word.
I liked what Bernstein said this morning, that Google or Alphabet is the warm hug of big tech earnings. It's sort of the least controversial name. And while it is sort of subject to AI hype and promise and economics, really that advertising model that makes up so much of its revenue remains sort of the thing that long onlys really look to. And it's been more resilient than some of the players like Snap and Meta. So the warm hug, I'll leave you with that, Kelly, a warm hug. How about that?
We went from hugging our employees to now a warm hug. This is just a lovely show. Thank you both. We really appreciate it. Chris Murphy and Deirdre Bosa.
Interesting. Yeah, I can't wait for obviously this week. I don't know if you guys have seen all these different earnings that are coming out here this week. It's a huge week. You got a lot of dividend stocks reporting Tuesday. After the bell on Tuesday, you got Mr. Softy, Google McDougal. You have Visa. You have Meta, obviously, after the close on Wednesday. You have UPS before the bell on Thursday. You also have Southwest Airlines, which I'm actually really looking forward to hearing what Southwest has to say. And then after the bell, you have Amazon and Enphase reporting. Enphase is going to be huge earnings, given what SolarEdge just reported. So can't wait to hear what they have to say. Obviously, Amazon. And then on Friday, you got all the oil, many of the big oil and gas giants reporting. So it's a big week, man. And I can't wait for everything that's going to transpire. So appreciate you guys joining me as always. Thank you so much for being here, folks. Make sure you join my Patreon if you're interested in that and seeing exactly what moves I'm making and exactly how I'm building up the Patreon portfolio. That is pinned comment down there. Much love as always. Thanks for being subscribed and have a great day.